Well, it's a good observation. I think inflation has softened a little bit during that time period that you're talking about, and over a slightly longer period, you go back to since the Fed started raising rates. I was always a little nervous. Was this the right time to start raising rates? I think early on, 2015 December it was, 2016 it was, but I was worried. Was inflation going to get up to 2%? Our objective, which is symmetric, so we should be above 2% sometimes and below. And I think it's worked all right. There was a moment, there was a period of time after, one of the big phone companies had big reduction in their data rates, and the CPI, the data, was very light for a while. Was that temporary? Was it something else? And, we've been under 2% for a long time, so I've been worried about it. And then, sort of, with the most recent nervousness, I'd just say, I think that a little more accommodation would be helpful for ensuring that we confidently get to 2 and above 2%. I really think that 2.25 or a little bit more than that would be about appropriate for our economy and monetary policy. At this point in the economic cycle, we're 10 years into an expansion, and if we're ever going to be above 2% during this cycle, you would think this would be about right.
I will say you have been very consistent about your concern about what you call the symmetric inflation target, which I guess means if you run a little bit under 2%, you shouldn't be too concerned if you run a little bit over. How much help does the economy need from the Fed in getting to a 2% target?
Well, that's a great way to ask the question, because there are other ways that we could get to 2% if we had even more stimulative fiscal policy, or if the state of the global economy was much stronger so that increased exports. If the state of the economy was even stronger than it is now, and it's really quite solid, if there's other additions to aggregate demand, that tends to increase inflation, and then the Fed wouldn't have to do as much. At this moment, the way the economy is going and the state of anchored inflation expectations, we just seem to be a little bit less than 2. It's not bad, really. I mean, I think it's a danger for the strategy of monetary policy if it's perceived that we can't get up to 2%, and 2% is thought of as more a ceiling. But, other factors, stronger business environment where investment increases, more people coming into the workforce, growing economy, that would tend to lift wages and lift inflation. And so we only really should be doing as much as is necessary, but at the moment it seems like a little bit more is necessary.
The market debates, I think, the following issue. If you were to cut in July, is it a one-and-done thing? Is it more than one 25 basis point rate cut that's needed? Or do you do what has been talked about, no less than the Fed chairman has talked about, this idea of an ounce of prevention is worth a pound of cure, which is as you get down towards zero, the Fed ought to act early and act forcefully. Where do you come down on those three issues?
They're all important. I think that
you can't do all three at once in July.
I think that we need to, have our strategy in mind, and so I think that it's very important to ratify and be very affirmative that inflation can go above 2%, that it's not a ceiling. And I look at the forecast that I was asked to submit in June, and in order to get inflation up to 2.25% over the next 3 years, I needed 50 basis points of more accommodation. And in fact, maybe that's not quite enough. I kind of think that would increase inflation expectations, and that would help. So on the basis of inflation, last time I was on talking with you, I had the same story, which is I think inflation itself is enough. Now you talk about an ounce of prevention because the global economy is weaker than certainly it was in 2017. 2017, it was very strong. And now it's moderated and it's a little bit weaker. So that's not a source of strength. And so from a risk management standpoint, it makes sense that you might think that we're a little bit more restrictive because of that, and we need to be even more accommodative.
You didn't mention trade in that list of things that you're concerned about.
Well, the global economy is weaker. There are trade uncertainties. Obviously, the administration is pursuing a different trade strategy where there's aggressive use of tariffs, brinksmanship, trying to get other countries to alter their policies, and we'll just have to see how it works. It's a different style, but that comes with adding more uncertainty, and you're never quite sure how the other party is going to react, and so it's not what I do for a living. But in terms of how you think about businesses must be reacting to the overall environment, it seems like this injects uncertainty into into their decision making.
I think the sum of your answers already answered this question, but I just want to be clear about it. You would still be an advocate of easing policy if there was suddenly a deal between China and the U.S.?
Unless I had great reason to think that that would somehow create a lot of inflation, yes, I think that's right. I think on the basis of inflation alone, I could feel confident in arguing for a couple of rate cuts before the end of the year.
All right, one more question on near-term policy here. I paint the following picture of this fictitious economy. Unemployment near a 50-year low. A recent payroll number that was well in excess of expectations. A strong retail sales number just this morning. Economy running roughly at the central bank's view of potential growth. Inflation 0.3 below the Fed's target, or the central bank, the fictitious central bank's target. You give me that stuff on a piece of paper. I don't go from there to you need to cut rates. How do you explain or cut rates into an environment where it seems like the economy is doing reasonably well?
I was expecting you to say the opposite. I was expecting you to say that's exactly the argument for a rate cut. The economy
That's why I'm not on the board.
The economy,
among other reasons.
Right. Economic fundamentals are solid.
Right.
If what we really mean is we're supposed to provide monetary and financial conditions to promote maximum employment and price stability is symmetric, 2% inflation, we need to go above 2% at some point, or else I'm worried everybody out in the audience and around the world is going to go, that 2% certainly looked like a ceiling, didn't it? They really were worried about going above 2%, weren't they? They were under 0.3, under 2%, and for how long? I mean, we haven't cracked 2% on a sustained basis since the Great Recession. And, if you don't do that, I worry a lot. Yeah, I don't want anybody to think that we're in a position like the Bank of Japan where they got really nervous about all of this and they've been, dealing with it. I think the European Central Bank has been a little bit better, but behind what we've done at the Fed. So, I think those are the issues.
One more follow-up. I'm sorry, folks. I do want to move on to the broader questions. But you said 50 basis points of tightening is what you think is needed to bring inflation back up. Do you have a sense of the timing of when that 50 basis points is needed?
The kind of exercise that we do, it's not so critical. I said before the end of the year. But I think what's the way that I think about this is I look at the forecast and what is it that's necessary to generate 2.25% inflation at least. And 2.5 is okay too, because we've been under 2% by more than half a percentage point. If you were to average 2 over some period of time, I think the way that this would likely happen would be consistent with a definition of symmetry. We probably need to work a little harder at explaining what we mean by symmetry, because I think everybody has a slightly different idea in their mind. I think part of the monetary policy conference that we were thinking about is kind of geared towards understanding that, or at least that's how I see it. But so I think that if 100 basis points got us to 2.5, well, that's still consistent with symmetry. I think a lot of this is, how is the committee thinking about this? How do the members come into the meeting? What's on their mind? I will say that it's a little lonely to be talking about symmetry and, it being above 2. We all say, yeah, it's symmetric, but when you start explaining what you think is consistent with that, mine is a bit more picturesque on the upside relative to, quite a few people. So that's why we go into the meeting, all participants talk, and we'll come out with a strategy. I would think we would be well served by overshooting 2%. I definitely think that we need to work hard to do everything that we can to get to 2%. With confidence.
We are going to get to this issue of why and the connection of the labor market to inflation, which is critical. But I do need to ask one other question, which is about President Trump, on a nearly daily basis now, criticizes the Federal Reserve Chairman and the Fed itself. He said that if not for Fed policy, we'd be growing faster. He said that this morning. Is that true?
I think we've had a tremendous amount of stimulus for the economy. We had a big tax cut, tax reform. They added more government spending. That's sort of, been waning now with the effects of that over a couple of years. And so we're coming down to trend growth? I mean, I guess the short answer is if you had more accommodative policy, you would guess that that would stimulate the economy a little bit more. I think that the path for the economy at the moment is one towards trend growth. I think trend growth is about 1 3/4%. We're looking at 2.25%, 2 to 2.25% growth this year, maybe 2% next year. That's slightly above trend. I don't think we should be in the business necessarily of generating excess stimulus in order to get growth up. We want to continue the expansion. There's no doubt about it, but find the right balance. It does turn out that because inflation is undershooting, that's a fine thing to do. So, yeah, I guess I am kind of saying, yeah, you know, it would have been stronger if we hadn't raised rates. There can be an argument for that. You got to be very careful in how you think about it. And there's so much else going on. I think the risk management argument is really a good one. Economy's solid. I don't really want to be talking down the economy because I don't think that's the state of the economy. It's just that there are a lot of risks out there, and there's Brexit, you know, October 31st. You know, no deal Brexit seems to be back on the table if I understand some of the discussions of the you know, future prime minister. You know, who knows how that plays out unless they also get some type of new deal from the EU. So there's a lot of uncertainty.
President Trump's been unique among the past 3 presidents, but not perhaps before that, in commenting on the Federal Reserve. How do you feel about the idea of the president talking and advising in sort of strong words what the central bank should be doing?
You know, I mean, we've got a job to do. We have to pay attention to the economy. We have to go out and explain why we're doing it. We have to explain why this policy is good for the state of the economy. Fundamentals are solid. So I think we've got a good story to tell, even with the maybe an ounce of prevention is the right measure at this time. So I think it just, you know, it goes with the territory, sometimes more than other times. But look, I think when you go out and state the case very strongly, which I think is very important, central bank needs to be independent. We need to have some distance between us and short-run political pressure because somebody's got to make hard decisions when the economy needs something that other folks would say, oh, no, you know, that would be too hard. Paul Volcker needed that measure of independence in order to raise rates to get inflation down in 79 through 82. And so when you ask for independence, perhaps somewhat arrogantly, I think you're saying, look, I'm going to be accountable. You get to criticize, and you got to have a thick skin.